Good afternoon, and this is Robert Rayburn here at Life Pro Asset Management. It is March 24th of 2022. I got the year right this time, and we certainly want to welcome everyone for attending this week's market update. A lot of the higher quality, long-term secular growth plays that we focus on have continued to consolidate and move upward off those very stressed out levels from a couple of weeks ago. So what we're going to go through today is this idea of investing through a so-called threat of nuclear war. I mean, that's how bad the rhetoric, that's how bad the sentiment has gotten, where we are actually answering questions about how do you navigate a potential nuclear war. And when we hear stuff like that, that tends to be very emblematic and very symbolic of extreme pessimism. And that's where we actually want to invest in. So what we're going to do today is go ahead and get started. And as you can see, whenever we have these times of extreme uncertainty, we know that the press and the media is going to come out with some very extreme headlines, right? Some headlines that are going to be designed to instill fear and uncertainty in their viewership, but most importantly, eyeballs to drive advertising dollars. Us as investors, we want to stay focused on the long term, on the 99.9% of likely outcomes. And the most important question that we can always ask ourselves as investors is, when we went through other times of extreme uncertainty, 2008 to 2009, especially March of 2009, March of 2020, December of 2018, what do I wish I did during those periods of extreme fear? Do I wish that I sold? Or do I wish that I held on strongly or bought more of my favorite long-term businesses? And we'll let you, the viewer, answer that question. But today we're going to go over three things. What is the bond market telling us? And what does that mean for asset allocation and portfolio construction? Number two, how sustainable is the current bounce that we're seeing in the overall market, but in particular within the growth segment of the stock market? And is there risk of a recession? We know that's top of mind with a lot of viewers and clients and advisors out there. So we want to address that this week as well. Real quick, we've used this slide before, but I think it's a powerful slide. And we always want to ask this question, is it different this time, right? So when we look at back of the major lows, March of 2009, capitalism is dead. The banks are failing. The US is potentially going to go bankrupt. Was it a time to buy or sell when we look back? Or when we look at December 2018, the Fed's going to cause a recession, time to buy or sell. That was a 20% sell-off in the S&P 500. COVID, global pandemic, 20% unemployment. Was it a time to buy or sell? Now, each single time, the Fed's going to respond differently. There's going to be different mechanisms that put in a bottom of the market. But the one commonality is the extreme pessimism that is very emblematic of these time periods. That's the common denominator. And that's how we really want to navigate the buy and sell decisions. When everyone is pessimistic, that's when we want to be optimistic. That's when we want to be greedy. And so this time around, will Russia cause World War III? Will there be nuclear war? Well, ladies and gentlemen, one thing I will say for certainty is that if there is a nuclear war, the last thing I personally will be worried about is what my Apple stock is doing. Is it going up or down? I'll be racing off to the hills. So, I think that's the way we really want to approach portfolio construction is 99.9% of likely outcomes, determine is investor sentiment overly pessimistic, optimistic, and then make that decision based on that. Now, in terms of recession risk, we know that's top of mind. Will the Fed hike rates to the point that they break something and put us into a recession? Right now, we don't see an above average risk of recession. We just simply don't see it based on the data. Now, two of our favorite data points, when we look at overall consumer behavior, the high frequency stuff, not the stuff that's reported monthly or quarterly, but the weekly stuff that, are we spending more? Are we traveling more? We have our partners there at RBC Capital Markets put a great index together. It's called Go Out and Travel Index. So looking at flight departures, TSA throughput, air travel search interest, hotel bookings, all of these things, what we see is that Americans are increasingly traveling and spending more money. That's the first thing. Number two, joblessness continues to decrease. That doesn't happen ahead of a recession. Jobless claims, the weekly initial jobless claims number is one of the most accurate indicators as it relates to foreshadowing a potential recession. Joblessness tends to rise ahead of the actual recession as employers begin to cut costs, as employers begin to realize, hey, we have bloated inventories, bloated costs. We got to get rid of some people that we can't afford to keep on. That tends to happen ahead of the actual recession itself, because those newly unemployed people then stop spending money, and that actually is the part that takes down growth. So overall, we don't really see a huge above average risk of a recession at this point. So things continue to migrate upward and to the right. We do see a slowdown, right? US economy can't grow 6 to 7% forever. Now, in terms of that investor sentiment, it is extremely bearish despite the rally that we've had in stock prices over the last 5 to 10 business days. What we see here right now in terms of the level of bearishness, or the lack of bullishness, I should say, we really are at levels that we've only seen two other times. And that was, of course, in 2009 and in March 2020. And there was a third time right around the late 80s and early 1990. And so those have been three core time periods that we've gotten to these levels of bearishness. Every single time, I would be, surmised to say that it was a very good time to buy. So bottom line is easy rules to follow during times of extreme sentiment. When everyone is bullish, we want to sell. We want to take profits off the table, right? When everyone is bearish, that's when we want to buy. And right now, everyone is bearish. So I'll leave it to you, the viewer, to answer what you should do when everyone is bearish. But I think the data speaks volumes in terms of what we should decide. Now, the other big thing is that the bond market has had its worst year-to-date performance, get ready for this, ever. It's worse than 2015, 2016. It's worse than 2008. It's worse than the Great Depression. We've never had bond performance this bad. Now, that's key. Why? Because what's hurt the portfolio through the months of January, February, and the first part of March was that the fear of rising inflation led to rising interest rates. Rising interest rates crushed bonds, right? So we look at bond prices go down when interest rates go up, and lower bond prices, bad for risk, right? Because people look at higher bond interest rates and they say, well, guess what? That leads to less favorable conditions for risk taking, right? So in other words, companies that have growth way out in the future, well, that growth is going to be discounted at a higher rate. When we get to this level of a drawdown in the bond market, right? So where year-to-date performance metrics for bonds are greater than 10%, in fact, greater than the credit crisis of 2008, the mathematical ability of bonds to continue to sell off at that rate of change starts to decelerate. And remember, markets move in terms of rate of change, right? And a triangle is what the mathematical symbol for rate of change. And so as rate of change slows in terms of that bond selling, the reverse dynamic begins to take place. So rates are not rising as fast. Markets have already priced in the worst case scenario. And then on the equity side, what happens is, well, what were the asset classes and the stocks that did worse during rising rates? Those are the ones that we want to buy now. So in other words, as the pressure on the bond market begins to ease and is starting to ease, we want to actually focus on the growth part of the stock market, not the value part of the stock market, because value and commodities benefited from those rising rates. And then as those rising rates start to ease back, we actually want to be owners of the stuff that got hurt from the rising rates. So that really explains our allocation away from commodities at the start of the year and toward growth assets. We're 2 months too early, but we think that trade is starting to play itself out. Now, in terms of the quality of the recent rally, we look at any recovery, we want breadth and we want volume, right? We want more and more stocks to participate in the rally, and we want volume to be a sign of conviction by the wider investor community. And what we saw last week was the NASDAQ had the best 4-day advanced decline breadth period of all time. Why is that important? Strongest 4-day breadth event ever, because breadth symbolizes conviction and volume symbolizes conviction, right? And so that leads to, that only tends to happen during durable bottoms. So not head fake bottoms, but durable bottoms. If this was a head fake rally, and it could be, right? No, with the market, not everything is a certainty. In fact, nothing is a certainty. If it was a head fake, we would expect a narrow recovery and low volume, but we're not seeing that right now. And I think that's really key. In fact, the 5-day rally we've seen in the NASDAQ was one of the top 1% of rallies ever. In other words, we're buyers of this rally. Now, as it relates to inflation, we know that it continues to grab the headlines, but this is overall the level of the number of vessels that are waiting in line, both in LA and Long Beach. And what we can see here is that that traffic jam, so-called, is starting to fall, okay? So we said to ourselves, okay, as ship traffic begins to ease on the US West Coast, what does this tell us about future inflation? Is there a way to take this data, this chart on the left, to understand how it impacts future CPI or future inflation? So then we looked at, okay, what's the Cass Freight Index telling us? So the Cass Freight Index is a measurement of the number or the level of freight that's being shipped toward the US. And what we see here is as freight activity tends to ease back, it tends to be a 6-month leading indicator for what we're going to see with inflation. Is it 100%? Of course not. Nothing in statistics is 100%, but it's statistically significant, and that's the key. So as the freight index rolls over, we tend to see historically CPI follows suit about 6 months later. So the question is, as freight activity has rolled over, is inflation next? And certainly we've seen a lot of things to suggest that it very well might be, right? We look at Chinese PPI inflation, that has started to roll over. We look at wage inflation in the US, 0% last month. So from an inflationary standpoint, that is good. So again, what's the number one thing that hurts technology and growth stocks? Inflation. What happens when inflation rolls over? Those stocks tend to benefit. So that's why we are overweight those areas of the market. So as the recovery broadens out, let's stay focused on the best of breed companies, not those negative earnings or idea or concept stocks. Best of breed companies going from good to great that got discounted during the pullback. 3 bottom line takeaways: higher consumer spending, lower joblessness, reduces recession risk, doesn't increase it. Ignore the media. Number 2, the NASDAQ recovery is currently backed by strong breadth and volume. That's a good thing, increases our level of conviction. And lastly, ease in supply chains does suggest that inflation is beginning to peak. So if anyone has any questions or concerns, please feel free to reach out to your advisor, reach out to us. We're more than happy to help. And other than that, have a fantastic and great weekend. Thank you.